Dividend stock investors are looking at Caterpillar and Deere and asking me which one is the better stock to buy. I'll answer that question in this video by comparing these two dividend stocks across critically important financial metrics, including revenue growth, operating profit margins, and returns on invested capital. I'll also share with you my fair value calculations for these businesses so you can see what I value these companies at and compare them to their current market prices to see if they're undervalued. I'll also share with you the valuations on a forward price to earnings basis so we get an additional perspective on valuation. I'll do all that in this relatively short video, so let's get right into it after a brief message from my sponsor. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So looking at these two companies' revenue growth rates over a couple of decades, we notice the cyclical nature of their businesses. They are up and down businesses. When the economy is booming and demand is increasing, their revenues are growing. When the economy is retreating and demand is decreasing, they experience a slowdown. Additionally, the products they sell are long-lasting goods. So when there are purchases made during a certain time period, that creates a gap for consumer demand for its products from its customers, and that creates that cyclical nature of the business. All else being equal, a cyclical business is more risky than a stable business. And it's because with a stable business, it's easier to manage. You know what your sales are going to look like for the next year, for the next quarter, and it's more easier to manage your business based on more certain customer demand and customer purchases. The difficulty arises in not knowing how many people you should hire, how much inventory you should create. All of that makes it more risky that you make a mistake. You order too much, you don't order enough. And that makes these kinds of businesses more volatile than businesses with more stable demand, like, for instance, McDonald's, which experiences similar demand regardless of the position in the economic cycle we find ourselves in. Despite those ups and downs, they both managed to increase revenue meaningfully over the previous few decades. Deere managed 37.6 billion in trailing 12-month revenue. That's up from 19.4 billion in 2005. The peak revenues for Deere came at 2023 with 55.6 billion. And Caterpillar also had its peak revenue in 2023 at 63.9 billion, and it's fallen to 59.6 billion, which is still significantly higher than the 34 billion it reported in 2005 on a trailing 12-month basis. The next metric I wanted to compare these companies on is their operating profit margin. And similar to their revenues, their margins are cyclical, but remain positive. At the very low point, Caterpillar generated operating margins of 4% and 4.9% at their lowest, while Deere generated operating margins of 8.5% and 8.9% at their lowest. It's comforting to know that these businesses, even at their low points, still generated positive operating profit margins that were reasonable. They weren't anything to write home to mom about, but they were reasonable margins to be sure. In the most recently updated periods, they reported 14.6% operating margins for Deere and 18.8% for Caterpillar. These are solid margins for companies in this heavy industry, heavy capital industry. You're not going to see margins like you see in software stocks. So margins in the teens, the mid-teens to high teens for these heavy capital industry companies. I think it's reasonable, it's solid, it's on the higher end of these types of businesses that you'll find. Next metric I wanted to compare these two on is their returns on invested capital. 13.8% for Caterpillar, up from 1.7% in 2017, and 5.5% for Deere, up from 3.4% in 2016. The high points for these two again in 2023 at 17.1% for Caterpillar and 12.5% for Deere. And what's encouraging is through these cycles, with each cycle, these companies reach higher peaks in both revenues and operating margins and returns on invested capital. So that demonstrates to me they're getting better at operating their business through each cycle. And that's something that I like to see when I'm thinking about making an investment. So now that we looked at the important financial metrics, let's look at valuation. And Deere, my discounted cash flow valuation model, I updated yesterday. The intrinsic value per share I calculated is $581. The current market price is $475. Now for Caterpillar, I calculated an intrinsic value at $375. The current market price is $418. If I apply a margin of safety, which I like to do, Caterpillar stock looks fairly valued and Deere stock looks undervalued. By the way, the charts that you're seeing, I'm getting from fiscal.ai, my preferred data provider. There's a link in the description for their services. You get a discount if you use my affiliate link. Now, when I pull the forward price to earnings ratios, Deere is selling slightly more expensively at a forward PE of 24 compared to Caterpillar selling at a forward PE of 22. Now, I have both of these stocks rated as a buy. I like both of these companies as long-term investments for dividend stock investors. If I had to pick only one, it would be a close decision. This isn't one of those easy decisions. But if I had to pick only one, I would select Deere because of the more favorable valuation when measuring by my discounted cash flow valuation model. It's clearly undervalued, whereas Caterpillar, when applying a margin of safety, looked more like a fairly valued business. It's a really close call, and no one is forcing you to pick only one. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.